welcome everyone. I've met a few of you. Whoever I've not yet met. My name is Manoj Agrawal. I'm the founder editor of Banking Frontiers magazine. I'm really happy so many of you have shown up here today for this discussion. We really hope it's going to be a wonderful discussion. The objective of all these discussions that Banking Frontiers does is for sharing of that special knowledge, that special insight, that special experience that you have that is worth sharing and that is worth getting from others. So once again, thank you all. We will start with a brief introduction of everyone. And yes, let's start.
Hi, good morning all. I am Alok Pathak. I'm Chief Risk Officer at Utkarsh Small Finance Bank. Thank you.
Welcome, Alok.
Hi everyone, good morning. I am Bhavin Patel, co-founder and CEO of Lending Club. We are a peer-to-peer lending platform.
Welcome, Bhavin.
Hi everybody, I am Prateek Garg. I head the strategic alliances and co-lending business for Ambit Finvest.
Welcome.
Hi, good morning everyone. My name is Vikas Sharma. I am handling treasury in Sriram Housing Finance.
Welcome, Vikas.
Hey, hi everyone. My name is Bobby and I'm part of IFL Home Finance, which is a housing finance company. And I manage the co-lending relationships as well as construction finance business work.
Thank you so much.
Hi, I'm Amol. I am Chief Product Officer at Neo Growth Credit. Thank you.
Welcome.
Hi, I'm Sanjeev Singh. I'm heading digital assets for Bank of Baroda. So co-lending is a part of the digital assets. So thank you.
Welcome.
Hi, Sajeev Vishwanathan. I'm CEO and founder of New Street Technologies. We'll talk a lot more about us in a while.
Good morning, everyone. I'm Shirish Lal. I'm the Chief Business Officer for New Street Technologies. Great to have you all.
Welcome, Suresh.
Hi everyone. My name is Nipendra Singh from SK Finance. We are based out of Jaipur. I take care of consumer loan for the SK along with the co-lending piece. Thank you, sir.
Thank you. Welcome.
Good morning all. I am Ashok Kumar. I represent New Street. I am an ex-CTO of Karur Asia Bank.
Welcome, Ashok.
Hey, hi all. I'm Amit Mande, Chief Revenue Officer for Ugro Capital. I manage the asset side and the co-lending and the off-booking of the balance sheet. So that's what I do.
Welcome, Amit.
Thanks. Morning. My name is Sendil Velu. I am the Chief Product Architect at New Street, and I handle the engineering department and the engineering team at New Street.
Wonderful. Welcome, Sanjay.
Hi, I'm Mernosh Tata. I'm the CEO at Edelweiss Retail Finance, and we are quite keen to grow on the co-lending side.
Thank you. Welcome. Okay.
I myself, Priyanka Multani. I'm from New Growth, looking after co-lending business.
Welcome.
Hi, I am Aditya Desai. I am part of the product team at Neo Growth.
Welcome.
Hi, I'm Raghavan Tia. So I am the National Operations Manager for the SME business for Edelweiss.
I am Kishore. I'm part of the product team of New Street.
Welcome, Kishore.
Good morning. I'm Naresh. I take care of the business development of New Street Technologies.
Welcome, Ganesh.
Yeah, I'm Mustafa from 7i Capital. We are in Western Bank based out of Mumbai.
Okay.
Morning, everyone. Arun Prasad from New Street. I'm the Chief Operating Officer at New Street.
Welcome.
Hi, good morning, everyone. I am Tapas Sarkar, partner at 7i Capital.
Welcome. Thank you. Great. So let's begin.
We can see blockchain at that cusp today. Why? Because there is one element of blockchain which is very, very attractive. One blockchain ecosystem can come together and become the glue of many, many architectures, which is interesting from another perspective for bankers. We all used to depend upon, or still do depend upon, our life depends upon core banking systems. Because we think when co-lending comes into play, and if it has to really meet its potential, you need a ecosystem which can work for everybody equally with a single version of truth. That's what we bring to the table. Thank you very much.
Okay, so let me just give you some context on how did we see this, and then quickly arrive to the question and the point where we need to open up the panel for discussion. Our immediate target is to become a 5 trillion economy, and when we go deep into it, we realize that what is that which is required. why what will help the most. So there will be 10 things which will make us a 5 trillion economy, but what will impact the most is, there's a huge credit requirement. Businesses needs to grow, and as we stand right now, all the stakeholders are in this room. We have a huge credit gap, a $1 trillion credit gap right now, which we have to address. And now, for doing this, actually, it is imperative, it is important to have these three things in place. So we have to create easy access to credit. Now, these are no-brainers. This is something which all of you are working on. We have to create easy access to credit at a low cost, definitely, because the kind of credit which is required, it has to come at a lower cost, and we have to focus to high impact areas. PSL is the focus area for both NBFCs and banks, and especially MSME is the focus area, which can actually drive the economy towards this objective. So if you see today, to achieve this, what is the infrastructure which is there in the financial institutions, which is whether it's bank or an NBFC? There are prevalent three models which people use. One is their own lending. So they use the branch or their own staff lending, branch-led lending. And then there is the BC or the partnership model, which we call either it's a BC or a DSA arrangement, which we have with between various organizations. And then there is the institutional lending. This is banks giving credit to NBFCs and NFIs in bulk. And all these models are the prevalent models. What looks like to be a solution is the co-lending model. Because if we see all these limitations, the co-lending model kind of eliminates all these limitations. And co-lending model, if there are three participants, then this is a win-win for all, for the bank, for the NBFCs, and for the customers. These are the three main participants for the co-lending model, whether it's CLM1 or whether it's CLM2. You have all those limitations in the prevalent models getting solved here. But the biggest question is that why it is the co-lending model is not growing as per potential.
Absolutely. Thank you, Sirish. What are the segments where you really see the potential to quickly, what is the low-hanging fruit in terms of customer segments, in terms of geographical segments, in terms of financial products? What is your experience?
So like you said, simple product. But clearly, I think one thing that we all agree that the custodian for the liquidity will always be large public sector banks. And that's not changing. The credit gap, like you rightly highlighted, I think the credit gap is there, and that is why the NBFCs exist. The existence of NBFCs because NBFCs can get the reads, can get products customized what the traditional banks can't. Mm-hmm. Right? So that's part. Second, we've seen that this whole institutional lending or lending to an entity, at a point of time, the banks realize that they have either reached the limit or there's a limit to which they can take an exposure on the entity. There is a large entity risk, and that's what we saw in the IFS and the other crisis, the other NBFC crisis, right? So the fact that in the co-lending, one thing that the co-lending does is really partners the entities that have the expertise on reach, underwriting, collections. That's one, which are essentially NBFCs, and the large custodians of liquidity, which are essentially the banks, to deliver this required credit to the last mile.
So, and we are predominantly a housing finance player, and from a co-lending perspective, also we have also signed up with about 5-6 players, but with two major players, we have really had some traction. And in the last financial year, in a 6 award, we could book about 1,700-1,800 crores of business. So, from a product perspective, if you look at every product can be co-lended, right? I mean, see, it is not that whether it is a PSL, not PSL. Today, if you look at bank have got no shortage of liquidity. Every bank is sitting upon large amount of money, and they have the appetite to lend also. The only thing is that they don't have the they may not have the distribution to reach with the kind of customers they are looking at, and that is where the co-lending comes into the picture. The PSL thing has come into this thing only because the RBI said that you can do co-lending only at the PSL. That's the only reason. Otherwise, be it a car loan, be it machinery loan, be it any loan for that matter, you can do a co-lending. And here, I think the banks also have a confidence because there is always skin in the game, right? I mean, it is not that you're originating and you're passing it on to the bank. You always have your 20% with the customer. And
So, which are the low-hanging fruits that you are to see in the near future?
So I think for the time being, at least for the next 1 or 2 years, it will continue to be in the MSME segment and the housing loan segment, in the PSL segment, PSL housing loan segment, because there is also a huge push by the government also for promoting, not only from a plotting of a circular perspective, but a lot of times we hear this when the head of banks meeting happens with the finance minister also. There has always been some kind of a questions asked by her on the progress in co-lending. That's the feedback which we are getting, and that is also putting a lot of that pushes the banks also to move ahead. The most important point is that any product where you can come up with a joint policy is critical. As he was mentioning rightly, so both operate on different systems, different policies, different way of underwriting, different way of looking at documents. Say, for example, a bank's way of looking at documents will be more to do with physical documents, right? Most of the NBFCs will not even be collecting documents. Say, for example, in our housing loan business, we don't have any physical documents at all. We are 100% digital. So you may have to the banks also. So what happened is that when we started interacting with the banks, we started explaining them. Though it took some time, now people have accepted this thing, and that's how the traction is picking up now.
I'll take it from what series has told. 2018 was this concept has come. But till now, what my Ugro colleague is telling that 1,000 odd crore kind of a business we'll do in co-lending with many. And in this group, fortunately, we are the only big public sector bank present over here. So, and we are in partnering with Ugro also for MSME for last 9 to 10 months. Recently, I took charge of the department, but I was trying to figure out what went wrong, why it has not kicked up till now. So partly what I understood, maybe a part of lack of clarity or aggression from the part of NBFC also, because whether it is a model number 1 or model number 2, we have to have directly or indirectly exposure with NBFC also. So there are certain criteria, certain policies that bank has to figure it out, which NBFC we have to partner. Like there should be a rated, there should be adequately capitalized, capital adequacy, net NPA ratio, gross NPA ratio, so many things comes into picture. So the reason I am believing why it is not picking up is partly because of the big role public sector bank has to play. He rightly mentioned that if co-lending actually has to take a, you can say, great jump to bridge that 1 trillion credit gap, public sector bank all have to come together, put it in a valiant effort to bridge this gap. And public sector bank, by nature, they are very conservative. Whom to take exposure, what to take exposure, how to take exposure, then developing a. I think we have now reached to 80-90% of our program, only the policy part and common lending program to be figured it out. And we are going to be the only public sector bank where it is to be straight through process. Entire thing in MSME is going to be STP only. That's why it is taking time, maybe delayed also. But I am hopeful that I am in charge of that. I have to ensure that within a month time, or say in the next 30-40 days, we will take a launch. But how to take it forward, that partly NBFC also have to be very aggressive. They also have to focus on their balance sheet to strengthen it, to have a fruitful partnership in future. And the bank, public sector bank also has to open up. They also need to formulate the policy as fast as possible, technology part. There is no dearth of liquidity in any of the public sector bank as on date. We are open for the lending and we are aggressive also. But how to reach, when to reach, how to figure it out, the things as fast as possible with technologically proven means is a challenge. And once we are hopeful that once MSME model is stabilized in a month or two, we will be very aggressive on the retail part also with maybe India Bulls, IFL and all. These things are parallelly also we are working it out. So the call is very, they saying that you have very good initiative that the series and all this team has taken. Really an area which needs a focused attention, not at a just roundtable level, but at a much bigger perspective. It has to be there because the best part is that 80-20 or 70-30 or 60-40, whatever is the ratio of the sharing, is that it should be hassle free, right? And if it is supported by blockchain kind of a technology, the straight through process journey, so lot of risk mitigants are automatically taken care of. Appraisal quality is very good, right? And for the customer, it is absolutely hassle. As you said, that within 3 to 5 minutes we have disbursed Kisan credit card. It's really amazing thing to do because I know I have been a branch manager, I have been a field worker. It takes 1 month time to give one Kisan credit card. Why? Because field investigation, then the land records detail and all to be verified, that the customer due diligence, that the manual appraisal, maybe 3 page, 4 page, 5 page, but it takes a lot of time. So if you are able to do within 5 minutes, within 10 minutes, within 30 minutes, it is something that need to be penetrated deeper further. And all big banks should come into play. That is going to be the day.
Yeah, 2018 from the co-origination where the challenges were very high on operational pieces. You had the regulator come back in November 2020 talking about the co-lending circular. That itself gave, I think, a lot of tailwind to most of the NBFCs because you could now under Model 2 really look to scale, right? So I think what really differentiates the latest circular is that the regulator has taken heed of all the conversations which happened with public sector banks, NBFCs, and realized that if it has to scale up, if we have to reach anywhere near this mark of $1 trillion, then you've got to scale. And to that extent, a Model 2 approach, at least that's what we've seen in our case. We've also tied up with one. We actually we had tied up on the co-origination side with 4 large public sector banks, one of the first movers. But we realized that the challenges were quite high at the operational level. Now, the co-lending side, which is in the new circular, in Model 2, once you agree on common lending parameters with the partner bank, you are actually able to seamlessly get the transaction disbursed. And then on sample basis, the banks will review it and onboard it. Right? So the approach, I can clearly see the regulator also thinking on this. The waiving of minimum holding period for these transactions is a big plus. And I think it is incumbent on the NBFCs as well to think of this long term, right? Because what you don't want is to build large books and then when the credit quality suffers, this whole co-lending model itself becomes a question mark, right? Today, it is flying under the aegis of the regulator because you've got a lot of these things going in for you with no MHD, etc., and like we spoke about the fact that you're covering PSL clients. So I think one of the thinking that everybody also needs to really keep in mind is that we don't want it to be a great start and then people or NBFCs, I think, I'm talking for us more, we need to ensure that these are long-term strategic partnerships because many of our banks are liability providers as well on the other side. And like what Amit mentioned, gone are the days where you can expect banks to give you large lines on your entity. I think they will more often than not want to partner with you, and maybe co-lending is one such agreement, on-lending is another one. There are many such ways where the banks will partner with you rather than taking direct exposure on your books.
Fantastic. Let's move on to question number 2, which is, we have discussed some of these parameters, but what is there some kind of number you think in mind that this partnership should achieve in terms of rupees or in terms of whatever other parameter you would like to measure, such as percentage of business?
Interesting. We've been engaging with a lot of public sector banks. Somewhere outside there is a perception that, or let's say go back 3 years ago or outside, there's a perception it's a public sector bank. The world there is changed. That's number one. the intent is clear. The intent is clear and everybody is talking about large numbers on co-lending. So in our last meeting with SBI, they have a target of 20,000 crores on co-lending. Some other banks have 10,000 crores on co-lending as their targets. So I think there is about somewhere there's a direction from the regulator, from the finance ministry that the co-lending business has to be really large, and I think it's about between 30 to 50,000 is what will happen between this year and next year. So that's one.
Okay.
Two, I think on the path to this for this to happen, these public sector, when I say public sector banks, and I think my view of public sector banks has changed. Sajeev sir said, they're completely integrated. The tech orientation of public sector banks is completely changed. I think the public sector banks today are more tech oriented than some of the private financial institutions. I was talking to, we were talking about KVB, and we are doing some co-lending with KVB, and there's a platform, New Street platform is already integrated with KVB. So every public sector bank has a platform where you can now connect, or will have a platform that you will be able to connect in the next 60 to 90 days, or maybe after 180 days, where co-lending as a process will become a part of their normal business. It will be a business by themselves. That's one. Two, a lot of banks, and this is completely new. All banks now have a separate department for co-lending. This never existed. A public sector bank saying, okay, I want to do co-lending. It's not about just fighting in an MSME department or a consumer department. There's a co-lending department. The co-lending department works on technology. There's a very high-end technology that is there, and the credit must be given to the intent in the public sector banks. That's one. Two, on the alignment of policy, I think.
Let's move faster.
On the alignment of policy, I think they have also realized that the traditional ways of underwriting is not sufficient, and so they are actually adapting to the entire data-based underwriting of, for example, IIF, and they must be doing a complete database, digital underwriting for your files. So everybody is adapting this data and tech kind of lending. So that's second, and I think that orientation change from having departments, having platforms, and really adopting to the risk philosophies of the other lenders is going to be the roadmap for the next 5 years to take it to about.
Let's hear from a private sector bank. Do you have something to say? Yeah. How does what do you see, the business evolution?
So my name is Prasanna Lohar. I'm from DCB Bank. I take care of innovation and architecture and all the digital initiatives at bank. So I think, Manoj, thank you so much for inviting me here. And so, sir, I think I have seen the MyFix demonstration when I was in Bangalore at New Street Tech office, and I could see that it's whatever it is said, right? MyFix enabled future ready. Today, the way we engage our customers for co-lending or any of those business opportunities, it is all about what technology available today. Maybe around web technology, wherein on front side we give this access to the customers or our employees on mobile apps or web application, and at the end of the day, we always have some kind of operation cycle. So this is a typical banking cycle, not only for co-lending, but most of our business operations. Now coming back to the co-lending, where there are multi-parties are involved. It's not only your bank, there is another partner with whom you have to involve. It's not only technical integration, because regulator will always say, keep on doing technical integrations, but how are you really taking care of a compliance and the reporting which has to happen back to the RBI, right? So it's a larger game. So today we may talk about 1 trillion, but it can go beyond that. How? Because that's a larger effect wherein the regulator comes into picture. But today, most of our regulations or compliance are around design and defined around current processes. But technology, so-called blockchain, comes and really changes all those processes and will go to some other level. So that's a larger picture. It's not only what we are talking today as a part of Neo Growth or Bank of Baroda or DCB Bank. So this is all around what we have designed, defined as on today. But what is coming in tomorrow as a customer experience, where customer is going to change. Customer don't want to come to your branch. Customer want to have all these facilities wherever he is sitting. It's not only on mobile app or a web app. Maybe it can go wherever he is standing, wherever he is looking for these kind of services. I think as we move on to changes in our currency, paper currency to digital currency, and this will become more lucrative and more prominent. So I think in the overall process, what we do traditionally today, so we have a complete customer onboarding process wherein there is some friction. Although we always say it is a pure play STP, there will be always a manual process because this is how design defined by RBI as far as the banking norms is concerned. But this kind of platform comes and says that we are ready with whatever regulation is required for, but also we have those gears or those parameters, we just on it, automatically it will become full fruit STP. For example, collection life cycle, or for example, at the end of a reconciliation or settlement. So I think that's my view that this is a future ready platform.
Are the MSMEs that we are dealing with today going
They
to
have to
do
change.
business the same way? We've seen Country Delight, milk distribution, everything changing, right? Now, what we are used to is MSMEs which do not have proof of revenue, KYC, unregistered with GST. How do we take credit? They're doing good business, but how do we give them credit? Now, these guys are all, and Prasanna brings out this point very beautifully. These guys are doing, changing the way they distribute, the way they do business, the way they procure their own raw material, leaving a digital footprint everywhere. And if we were to take that into account and say, if we're doing, I don't know how much the MSME outstanding is today, but if we have to hit $1 trillion, each of us will probably be looking at 10,000 crores of books, each organization, NBFC level, and probably hundreds of thousands of crores at a bank level to be able to distribute. If that kind of distribution has to happen in 5 years, I can see the transformation coming from the fact that every aspect of the entire trade and commerce itself is getting digitized. Are we leveraging that?
Yes.
And if we can leverage that, then the opportunity is there. That's how I would.
Just to support you, down the line 5 years, if you have to do that, we have to have a zero operations, rather negligible to zero, and
Correct.
that is possible with emerging technology like blockchain. And I'm not saying they are really ready, but we have to practice it out and really give a opportunity to that platform. And larger game is when we'll collaborate together and coming together immediately for that customer. Yeah.
So if you look at the current outstanding, I'll stick to lakh INR crore because the dollar is fluctuating. So if you look at 5 lakh crore is the outstanding of business loan
Okay.
to MSMEs. Another 5 to 6 lakh crore is MSME secured LAP, right?
Okay.
That the overall, and then you get into the higher end of MSMEs, which is medium and all, where you have structured finance of around 7 to 8 lakh crore. So 10 lakh crore of outstanding today to MSMEs, SME part of the MSMEs, it will be growing at a rate of 20% naturally, partly through nominal GDP growth, higher penetration, etc. My sense is that the co-lending bit where the partnerships come together can accelerate it by 2x at least.
Okay.
So these are the numbers that we are talking about. So 10 lakh crore maybe going to 30 lakh, 40 lakh crore over 5-6 years if the entire ecosystem works together and creates that penetration.
What Prasanna and a few more people said, that it's changing, it's evolving. So when regulatory compliance is evolving, when customers are evolving, when business models are evolving, when products are evolving, then you need a platform which is versatile. Okay. And so we need a lot of versatility in all aspects. So, and second thing which I'm taking away is that technology plays a very big role in the growth potential, the true growth potential to be unlocked for things like co-lending, direct assignments, and other aspects. Very well put point by Amit that it's not only co-lending, it's gonna, the collaboration between various financial institutions will go beyond the limits which we are looking at right now. So I want to come to the point of technology. So how technology can enable this. So if you see, there are 3 different processes of technology which is used right now. So one, all of us know that we have a semi-digital process where NBFC has a ERP system, bank has a CBS, everything else is manual. Okay, everything is else. And all of us, there was another point, somebody was pointing that there are departments so now created for co-lending. Today I was hearing introductions, 80% of them said that they represent co-lending in their organization. So this is how serious it has become. But if you see the technology side, most of you will agree that we are in the first stage. So if you call that the first generation, where there is technology, both organizations are digital, but they don't talk to each other at all. It's completely manual. It's a very high operating cost and regulatory compliance like real-time NPA tagging. Why do you think direct assignment has taken a back seat, especially for larger banks? Because regulation says real-time NPA tagging. And how do we do real-time NPA tagging when the process is manual? Last mile, regulator is not allowing 100% FLDG also. They are saying that, FLDG doesn't solve even if it's 100% because they want banks to have control on credit underwriting, last mile control. But when the systems are not talking to each other on real time, so the first generation is still there, it's prevalent. And the second generation, a lot of banks are now doing one-to-one integration. And this is now called the new age from last 3 to 4 years. That you, large NBFC, X bank come together, do a very complex API integration, takes 6 months, 9 months. I have seen it taken 18 months also. Some of you will agree with me. To do this integration, it's a way, and they talk to each other. This is the latest which a lot of banks and NBFCs are talking about. But what are the limitations in this kind of model? It's a very high effort model. Anybody from technology side here will, I understand your pain. The kind of pain a bank or an NBFC IT team takes to integrate with each other is very high. The cost is high, the maintenance is high, and it's a repetitive process. What happens if another NBFC comes? What happens if I go with another bank? I have to do the same process again. Okay, I will know what to do, but I have to do the same process again.
I was just mentioning that we are on the bank side right now and work with some small NBFC partner, started exploring the co-lending side. But what you are talking about, the use cases that, company to company, everybody has different products. So we work with a lot of partners, around 7-8 technology companies as well as finance providers, mainly fintechs. And everybody has a different virtue of their products. Somebody will have one-day repayment, another will have bi-weekly payments, somebody will have 15 days, 90 days, 1 year, multiple iterations in terms of repayment mechanism, delay charges, etc. etc. So around 2.5 years back when we started focusing on that product, when we executed the first partnership, we thought, okay, product is set. When we executed another one, when the repayment cycle came in, we realized, okay, there is another possible case. So we had to create a completely new system for common amortization schedule. So that as and when any new partner comes in, we can customize it. Now today when we have crossed 10 partners and we are looking at next 15, we realize, okay, ये system पूरा change करना पड़ेगा. Because what worked for 2.5 years for first 10 partners will not work for next partners. Because see, every fintech or every financial institution will have their own product. Now let's say if I'm a bank or kind of quasi bank who is providing capital to them, I can't be rigid. No, you will have to change your product in the way my product works or my system works. And that's the reason the flexibility is required. Now whether my own system remains flexible or somebody like them can come in between who provides me a flexible system that I can consume the information which is provided by them or repayment data provided by them. Otherwise, it will always remain on the Excel. So I can completely.
It has to be future proof.
It has to be. And see, in Lending Club specifically, when we did initial couple of integrations with partner and what I had seen across startup world, we always refrain to get into any manual processes. So that's the reason a lot of time it took us months. Like when we went live with GPay, Google Pay, it took 9.5 months for us to go live. Why? Because we do not work on Excel. They also do not work on any manual processes. And they have some certain quality criteria. Now possibly that would not come in place when I work with any NBFC partner or finance company because they will not have those quality criteria. But I think that's the way to execute a partnership deal, because if one person is compromising on something, it is going to hamper the relationship.
Discussing the second generation model where, there are different systems. So Babin was saying there are different products. So there are different systems. Somebody is using Lintra, somebody using Nucleus, somebody using Finacle this side, there's something else this side. There are hundreds and thousands of systems in the market. And they're not talking to each other. They're not compatible to talk to each other. And this API kind of an integration was the stopgap arrangement, but it is very expensive. And still the regulatory angle, which, a lot of you, Prasanna also brought in, we were discussing the regulatory angle, that it is not getting solved. If the regulations changing as they are changing, your data dependency. If you are a bank, you are dependent on NBFC to send you data. Okay, till now. And that data is not a automatically fetched data, that's a push data. Whether it's an API, whether an Excel, whether it's an email, it's a push data. You're dependent on somebody for data. For accounting, you brought in this point, different accounting standards. Somebody is at 365, somebody is 366 actual. There are 7 accounting models which different financial institutions actually go by. They don't talk to each other. So their GL entry handovers are very, very different. You'll understand this. Recon for your collection accounts, recon for your disbursement accounts, recon for your schedules creation, appropriation sequence. This is all done in separate systems and which are still not talking to each other. They are supplying data in the one-to-one API integration, but they're not talking the same language. That's the connect. And because of all this, they have a middle office cost. Now I want to, stress on the middle office cost. There is a huge amount of cost because you have to do audits, you have to do maker, you have to do checker, you have to audit everything. The data coming from NBFC, data going, bank doing the audit, data coming from bank, NBFC has to manage that data with a middle office. There are human, it is a digital model, but there is a lot of intervention. Somebody mentioned that we still have not gone away from the manual process. And regulatory compliance we have discussed. Now, the third model before I go in to my question for this technology segment is, we are now getting some platforms also in the market. Okay, so I call them man in the middle platform. So they are saying, okay, they are trying to solve the problem. They have kind of solved some problem that, the integration problem which used to take time, but they are man in the middle problem. They come up with a solution, but the biggest problem is information security. NBFC is giving their data to a third party. That third party is translating that data into their system and then giving it to bank. Then the bank supplies the data to the third party platform. They translate the data and give it to the NBFC. It's convenience. I agree, it's convenience. But it's huge amount of information security risk, because still the systems are not talking to each other directly. Okay, there's a man in the middle. Data dependency doesn't go. Somebody has to log in into the platform, submit the data. Somebody has to log in the platform and extract the data. That's how the platforms are working, which are there in the market. You again have the accounting recon office, because the data is not trusted. So the main word which I'm using here is trust. Okay. The trust between NBFC and bank is not there, hence the middle office.
Absolutely agree. So we at Ambit, I'll tell you use case, we have 15 plus more partners, either co-lending where we source business or we give business to banks. And I'm glad you bought direct assignment also in this, because I also look at that bit, and we do like almost 2 transactions a month, DA, PTC, maybe would have done 25 plus right now. It's a real challenge. I mean, having said everything, I think most of the things still work in Excels. And there is there's a joke, right? When you say digital, you are giving something, but at the end, there is again a man behind you taking the thing back. So that is what is practically happening.
You can't avoid the potholes.
Yeah. So, and the same reason when you mentioned, so we also haven't kind of gone to the third party platform, because again, of the data security issues, the trust factor. So again, I think this is something which we all need to solve for to kind of reach the target which we are mentioning. Otherwise, I think it's still, I will say, on the ground, maybe 95% of the transactions are still happening on Excel. Having said everything, the co-lending module, the CLM2 came in November 2020. It's been almost 2 years. I think a lot of it has come in the news wherein people are partnering. But again, the number on ground, it remains a challenge. On the product bit which we started earlier, I think we thought that maybe what I perceive, what we perceive right now, the banks are going strong on co-lending on the secured product, which again is more cumbersome related to unsecured. The secured needs legal, technical, etc., to kind of make it a STP. It becomes difficult. The thing which is easier STP is a unsecured MSME loan or a consumer loan, but unsecured MSME, there the appetite is not maybe as much as people would appreciate in terms to make this as a success. So I think this was something which I wanted to highlight. Yeah.
I'll let the slide, I'll park the slide for you guys to look at. Just to address something that Amol mentioned at the very beginning, that these easy co-lending unsecured loans, everyone seems to have done it, and we've ironed out all the wrinkles there. The challenge is when you look at the large ticket items, the complex deals, which involves PSLs as well as the NBFCs and fintechs, etc. And for lack of a better analogy, addressing your question as well, Pratik, it's like a swimming pool, an Olympic swimming pool, where you get to choose which lane to swim in. And there's always going to be this heavy underwriting process, paper trails, scrutiny, and I don't think we'll ever get away with it given the large ticket sizes and the volumes that we want to grow to. But then with technology, especially with blockchain, you get to choose based on how much data you're getting from the field, from your prospective MSME and client, what kind of risk you're willing to take, the processes that the MSME has met, you can pick and choose which lane to swim in.
Sindhil, if I can help you with this, let me analogize it in banking or financial services terms. Co-lending or direct assignment is no different from the old consortium-led lending model to corporates, right? You wanted to distribute risk, you wanted to share your balance sheet, so you got another bank to do a structured finance loan, a very complex $100 million loan. You got 5 or 10 banks to come in and enter into a contract with the end customer. The customer has a lot of covenants saying that they will use these funds only for this, and the norms between banks are sorted out. They enter into a consortium agreement, and there's a consortium leader who decides who will get what returns, who will take what risk, at what point funds get disbursed. Now, this consortium lending used to be the norm for the corporate world, large ticket sizes. That was a lot of legal work. The law firms used to make the most amount of money in these kind of contracts. So they used to put down a lot of covenants, and 100-page, 200-page documents used to get signed, and the loan used to be released as a structured deal over a period of time. And it used to be collected back also based on cash flows of the entity and so on. So we're talking about reducing that into a simpler place where balance sheet is shared and distribution is shared, so is the risk. So risk and rewards have to be shared. Now, when you do that for one customer with a large ticket, complex deal, it's easy to do over a period of time. But when you want to do it for a large number of customers, smaller ticket size, the economics won't allow it. So that's where technology has to come in, and you're reducing the contractual obligations into something which is easy to implement.
When we have, see the biggest problem is that, everybody calls a certain ratio. Everybody has got their own ratios for funding a customer. You decide this 10 parameters.
Right.
And even in that parameters, there is a difference with X bank calculating how this ratio is and the Y bank calculating how this ratio is. And that is when and that is exactly what he was also, I think, trying to mention, that everybody follows a different methodology for calculating different eligibility criteria, and that is where the integration becomes challenging also. That what I see as 70%, my bank might see it as 80% or 90%.
Right.
With one-to-one integration, as we all discussed, yes, these rules will be defined, discussed, and parameterized, or where you write the code. The biggest advantage when we come to the platform is that each organization defines their goal to us for the first time, where we have the business rule engine defined for each organization in the platform. So whenever new customer comes, we will do the BRE, and to start with, it will be one-to-one integration between NBFCs and banks. Going forward, it will be a multi, where many to many. Whosoever fits into the business rule engine, what you have defined, that customer will be thrown to you. So one-time integration is just sufficient for you to enter into the platform, because unless otherwise you tell what exactly you want, you will not get what is expected. How do you process the proposal? Each organization's business rule engine is taken and it is automated and it resolves the problem. Am I answered your question?
My only question was that, we have middlewares today. So as the third option which you are mentioning today, the only problem which I found you guys are solving is the data security issue. Other than that, everything else remains, right?
No, when you have to talk
so
to
far
your...
we have not touched upon the solution. We're still contemplating the challenge itself. And we have to arrive at that solution. Most of it points to, Shirish, you want to continue the flow?
Shirish, before you, I think to what Senthil said, and Sajiv, to your analogy on road with potholes, expressways, a point A to point B vehicle and a supercar, right? And to what Senthil said, I think there are two tracks that we need to look at. One, there is a genuine problem on hand because of a new thing that's come into the story to manage the life cycle of a loan, putting the flexibility rule engines in, having an agility of the platform to interact with multiple policy rules for different partners. That's one. The second is a futuristic one which Senthil was mentioning, depending with use of blockchain and ensuring that decentralization of your underwriting and credit policy and decision making. I think you as technology partners and technology leaders have to lead both the partners on solving both these issues at this point of time. And that's the real, because rightly so, we as financial NBFCs or banks cannot integrate with 50 people. So that's why the middleware to release our bandwidth.
SMEs are your core business targets.
So definitely. So like what we were discussing about, especially taking clue from him, what we are talking that why we are not able to grow the co-lending. So I think very first thing is more it is like KYC what we were talking. So it is like KYP. So partner to partner, understanding the partner. So like in this kind of relationship, the most important thing I believe what is really missing is like again you talk about nationalized bank or you talk about any private bank. So it's like understanding the type of customer. So now the problem will stay. Like in the co-lending also, interest rate charged by a bank will be something. And for NBFC, because of your higher cost and your other operating costs, you will like to have more. So again, somewhere we have to accept that, okay, this is my risk appetite, this kind of policy acceptance, those things are very common. So that part, we are talking about more complex point, that is definitely very important. But before that, I think solution comes from that part first. Acceptability, that okay, product acceptability, customer acceptability, interest rate, how to align that thing. So I think there we need to talk more actually. That both partners talk.
The business angle.
Yeah, business angle. Understanding that okay, this product fits to, or you can say at one point of time, banks have to say, I know this partner, whatever product they are taking, I'm sure about this. Because the moment we get that kind of acceptability, I think your 80-90% problem will go away. What will remain? This problem, which actually we should focus more, that how to create this kind of overall, that flow of the information, validation, authentication. Otherwise, what is the use of that? Why banks want to go for co-lending? For the simple reason, we don't have dearth of liquidity. So we have a lot of funds. All banks are having flushes with funds. They want one more channel, like digital channel, we are sourcing this thing. Simply, we want more channel to do the sourcing. Distribution. So I think this is the main thing, that distribution, and then using the expertise what NBFCs are having. Right. Because bank as a nature, they have to be like little stringent. Because we are more closely watched by a regulator, and so we have more responsibility towards the shareholders, depositors, and other things. Unlike NBFC, which slowly I think RBI will not leave NBFCs also for that. Right. And we have seen the big change actually, because we do a lot of NBFC fundings. We have a lot of partners sitting here. So I have seen a lot of changes in terms of processes, in terms of understanding product. So I think slowly that time is coming, but still we have to work more on that. And what we are talking about, the volume. So I think we are underestimating. So volume is going to be humongous. The kind of, like I have seen the requirements are coming, and wherever I am discussing the kind of growth what people are saying. So I think 1 trillion is nothing in the next 5 years. It may go beyond that actually.
Oh.
Yeah, definitely. Because everybody, see, if you go to any kind of geography, you will see that there will be at least 40 to 50% new to banking clients people are getting.
Mm-hmm.
So that itself shows the story that what kind of overall opportunities are there. So I strongly believe that big opportunities are there. These complicated things definitely we have to work, and I think all banks are working. Every bank is having some kind of department, innovation hub, technology people, product people who are working on this. But on software issue, I still feel that that kind of coordination is not happening, which is very important.
So I completely agree. So there are 2 points of the question. First point is that there are software issues because the covenants or the agreements between bank and NBFC regarding products, right, underwriting, area, interest rates, all those needs to be ironed out. Okay. So till the time that happens, because that will evolve, the understanding will evolve. Coming back to few things is that how is that happening right now? And how is it hampering the growth of the complete system? That's what we were talking in the previous slide. And answering to your question that, what are we doing? So this is a slide in which we are trying to tell you that what all we think is possible. What are all those things if it's data dependency, removing data dependency. Okay, first thing you was talking about, correctly you picked up information security. So if I remove data dependency, any manual or any third party intervention, that's a problem to be solved. All of us, we agree. Regulatory compliance. Nobody will disagree that when regulations change or we evolve the technology or the platform as per the regulatory compliance that is required. Automated processes, unified processes. This is the word which I'll continuously use, whether it's accounting, whether it's processes. Both organizations, if right now today 2 organizations are working, who knows, 3, 4, 5 or unlimited number of organizations may work in the future together. So there will be multiple systems, multiple processes, multiple accounting systems to be used. Let's come back to today. There are 2 parties. They have different processes of origination, loan calculation, schedule creation, accounting. All this needs to be unified. If this can get unified, your problem will get solved. Your TAT. Simplification of accounting, we have already talked about, and this compliance. So if today you require a huge source of people to do compliance at both ends, what if the system starts doing compliance for you? What if the technology enables that compliance, which is translated into trust? Trust, I'm not saying that banks don't trust NBFC and NBFCs don't trust each other. They are both fantastic financial regulated institutions. But the data, as somebody pointed out, the penalty of negligence or missing a data point is too high right now for any financial institution. So how can that be achieved? And right now for adoption of any technology, there is cost. The model has to be capital light. The model has to be low in maintenance. The model has to be quickly to integrate. You can't take 6 months, 1 year to integrate to a product. By that time, might be the things will change. And the last thing is that what the regulator also wants, the banks also wants, especially from the bank and regulator side, I'm saying, is last mile control. Okay. You want last mile control because regulator wants it, and it is good for the business also. Can you get control or visibility? Not control. I'm saying visibility on the time since the customer originates. Schedule creation, due date, collection, what amount of collection, real-time update, not wait for somebody to tell you what's happening. That will create such a huge amount of trust. These are the points which we think are leading towards one single line, which is Sajiv's favorite line, is that what we need is a single version of truth. If we can all agree to it. If we have a single version of truth on which both the companies are working, what is a single version of truth? The same compliance, the same business rule engines, the same accounting method, which can give one result to both the parties and they can trust it. If that happens, which is not provided by, answering to your question, in the current platforms which are available in the market, because they are just aggregating data from one hand to another. The trust, technology-enabled trust-based transaction on a single version of truth is what we studied, we researched, and we felt is required to actually unlock the potential of $1, $2, $3, or $5 trillion in the next 5 years for co-lending. If we agree to this, then I think we can introduce. I think Senthil have given you already a glimpse of what we are trying to tell or make to this point.
I'll just give you one example of what is possible, and I'll ask my bank friends here to say if they have this, what would they do? What would it mean to their business? I'll give you a simple example. There is Google Maps, which are now integrated with Route for collections, the MSME collections. It's very common, right? It's what Uber uses, it's what Swiggy uses. It's real life technology, and many NBFCs at the retail MSME end are already using this to track their field officers and so on. If a person does not go to pick up the collections on a given date, there is a schedule from the LMS. There is Google Maps which says where the person has to go and meet the customer for collection. If it's cash, and I'm saying a completely manual process. And if the person has not arrived, you have AI tools which give you predictive analytics, which says that that person who's supposed to be there has not got the money, or has not even gone there, or has gone there and has been told no money. Now, this information is available with the NBFC. Today, it is, if we say 1 to 5, most sophisticated NBFCs have this. The unsophisticated ones have not invested in this. But let's take the case of 5, where sophisticated NBFCs have predictive analytics of their delinquency before the customer is even, the due date has happened, right? If that information is available as it happens to the bank, how would that change the bank's perspective on co-lending?
So like client at the time of onboarding itself, they will frame some scoring model that, okay, this is the customer where collection has to focus more. So right. I think similar lines you are mentioning.
Yeah,
so definitely
absolutely.
It will be very useful.
So it is there. Yeah. And the fun is that truth that there is a person who's supposed to have collected the money, did not get the money, did not go there. All those combinations, one version of the truth exists. If that truth, vision of that truth is available to the balance sheet owner, not just the distribution company, which is the NBFC, but with the balance sheet owner, then the comfort between the bank and the NBFC will increase tenfold. And then they'll say, okay, just open the tap. And if you can predict that your delinquency for the next month is going to go down because you've put in more field officers or more collection mechanisms, or introduce a new digital way of collecting, correct, then the comfort changes, and that's possible. So that's why I think it's not, the future is not very far. Yeah. It's actually very easy to do it if there is a technology which can make it available. At the same time, you don't want the NBFC to give up proprietary information, so you permission that. Now, Ashok, you have seen this problem in an RBI audit where the KYC became an issue in a co-lending thing. Has that issue been resolved? What was the issue?
The issue there is when RBI came for, because I will just share my experience of co-lending. When I was the CTO of Karur Vysya Bank, we started our co-lending model with Amazon and Capital Float, where it was a very successful model technically, where we acquired nearly 4 million customers and a huge amount of book size. Biggest advantage is what I can share with you is that on Amazon sale days, we acquired around 30,000 customers in 24 hours. So that is the speed at which the project gone. We started too early, where there were no regulations. With what we, Capital Float and Amazon know, we started that operations. When RBI came to, because RBI is inspected, some 6 months back, there were some gaps because when we introduce systems, we are not much aware of what to do. Especially the KYC, what RBI is now telling on the KYC is that the bank should own the responsibility of KYC when you are going for lending. That is one of the very, very important regulations given by RBI. Second most observation up from RBI as far as the co-lending is concerned is that what is your business rule engine, what has been defined in the software? Is it approved by the board of directors? When this is from the from compliance point of view, when you are satisfied, when you can satisfy RBI about these two things, they said go ahead and increase your volumes.
The question that I wanted to again ask is, what exactly did the RBI want the bank to do in terms of owning the KYC? NBFC did it. It's a regulated entity. What did the RBI want the bank to be in control of?
The thing is, they as somebody was pointing out, whether the regulated, what RBI wants is who is having authority to do the KYC, and what are the process you followed while onboarding the customer. Is it as per the circular? If not, kindly do the re-KYC and confirm the KYC norms as per the circular. That's one thing. And as far as because when you are doing the lending in unsecured loan in digital mode with OTP, you have a limit. And if you had to exceed that limit, you have to do the full KYC, whether it may be physical or through video KYC. Whether those guidelines are implemented. Actually, we lacked it because we did not have much idea. With the OTP itself, we exceeded those limits.
So applying to this current context, so the 20% that the bank, 80% that the bank would take has to be a full KYC or whatever, depending on the prevalent norms at that point of time.
Because there were no norms at that point of time, we did not implement.
Exactly.
Yeah, because they are not bothered about what is the percentage of your risk cover. But once the bank is there in the business, it is the responsibility of the bank to ensure those guidelines are followed up.
See, we've had discussions with many banks, and I can quote SBI here, which is the largest, right, where we met the MD and they were very clear that CKYC done by the NBFC is good enough, right? I'm sure, sir, you will also agree. You see, earlier there were challenges because certain fintechs were not taking documents in line with the OVD circular. And probably that is the mismatch which the regulator would have seen. As an NBFC, if you are in line with the documents that you need to take, there are only 4 documents that you pretty much take for an OVD, POI, POA, proof. As long as you are in line with that, we have not seen any challenge. We do reasonably good business on co-lending every month with one partner. We are lining up with another one very soon. And we don't see that challenge at all. So today, I think it's not an issue.
Is that a case where the asset is recognized on the bank's books as a retail loan to ABC, or is it an institutional loan to the...
No, it's so as per the co-lending guidelines, basically it's a loan on the book of the bank. So they will create an asset account in the bank books for that 80%, right? And 20% stays with us, while the NBFC continues to front the entire life cycle of the journey. The whole idea, therefore, is to basically, for banks, they want these retail PSL loans. I mean, PSL or otherwise, they want these retail loans to make it more granular. And therefore, when you do this arrangement, it comes into the balance sheet. It doesn't go into the treasury side of the assets. So that actually, Sajeev, is where the banks are keen on to drive.
I want to bring one small business angle into this, which we have not covered, which is direct assignment. Do you see these two going on parallel, direct assignment and co-lending, or do you see them converging, or one will impact the other? What is the likely scenario?
No, so the co-lending model 2 is really direct assignment itself, right? So it's just that it's without minimum holding period. So it's really the same.
It's originate to distribute.
Absolutely.
But then it defies the direct assignment guidelines. You should not originate to distribute.
No, that's the only waiver, like what Amit saying. So the only MHP is the only thing which they've said, you don't do. See, I think the way I look at it is the landscape is every time an NBFC or a new product comes through, banks will want to cherry pick. When you want to cherry pick, you will probably not want to go in a co-lending arrangement because you're also not sure how the portfolio is performing. Tried and tested products, what we are talking about, whether it is business installment loans, SME LAP, equipment finance, etc. These are tried and tested products. Most banks would have had an exposure with NBFCs directly. They know the portfolio. They're happy to engage with you in a co-lending arrangement, right? Anything new that you want to do, I believe that it will start with a DA route. Like if you see earlier, used commercial vehicles, you didn't have a DA market. Now, over a period of time, whether it is Tata Motor Finance or any of these Ashok Leland, etc., they've created a market of DA. And tomorrow, if you want to do co-lending, I'm quite sure that the banks will be happy to look at co-lending because they've bought portfolios, they know how the portfolio is performing, and understand the nuances. So
are you saying that DA will morph or will progress into a co-lending model as the relationship?
Yeah, I think over a period of time, you will see more and more DA coming in co-lending. Of course, one has to be very comfortable. Even today, most of the public sector banks are very keen to buy your retail assets in a DA model. You talk to any of the banks, they're like, if you have specially secured assets, at any point of time, they have the liquidity to buy that, right? So the first preference will always be DA, even from a bank's point of view, because you cherry pick assets there. Na? You will slice and dice the data and say, this is the set of customers I want. Everything else you can retain. So that preference will be there. But I think over a period of time, we will see this evolving where both will coexist. DA more to do with where people feel the risk is high. Let's say unsecured business loans, you want to season it for 7-8 months, then take it. Maybe those models, personal loans, those models will probably be more on DA, PTC routes. And more tried and tested models where banks are comfortable, they will enter into co-lending.
See, try to understand the genesis, why the RBI has come out with this, because bank is bank and NBFC is non-bank. Right. So try to understand the definition. They are non-banker, right? A bank is bank. So it will take time to dilute that consideration. As he rightly mentioned, it's just the beginning. Let it be matured for 1 year, 2 year, 3 years period of time. Let us understand that delinquencies are not increasing based on the common agreement. If everything stabilizes, I think for the time being, RBI is not going to relax it. It has to be, bank has to do simply the trust is to be restored, and the trust can be restored only when the asset quality is intact. It is not compromised in the time to come.
See, the interaction which I have been doing with RBI over last 15 years and last 7 years being a P2P lending platform, which was completely a blank canvas. We brought something by pushing RBI on different aspect, right? So when the regulations were coming up for P2P lending, if everybody is not aware about, RBI was not ready to allow us to do payment transaction via our platform. So initially we assume, okay, we will figure out a way. But then we tried to understand RBI's perspective. Why you don't want us to do it? So RBI's perspective was in end of 90s, the problem which they faced with deposit taking NBFC. They didn't want to repeat that history. So we had to come up with data points, explain them that was a different era. Today is a digital era and we have traceability of everything. And now payment gateways are taking care of payments more than what digital physical transactions are. And ultimately we could convince them and they allowed us to do payment via P2P lending platform. However, what that taught us is regulator thinks completely in a different way. And we as a business owner thinks about a matter in a completely different way. Over last 2 months, I have attended so many co-lending panels, discussion with so many senior people from PSU banks and NBFC fraternity. What I realized is there are 3 major partners here, NBFC, bank and regulator. Now all 3 have their different priorities and all 3 of us are stretching the co-lending towards what we believe is the requirement from our side. I am not aware if there is a common group which is working towards it. In January 2022, when FinTech department was set up in RBI, I had given one suggestion to the ED. We had a one-to-one discussion for 45 minutes that, sir, whatever we want to achieve, let's create a small working group of you or some of your team members, us and couple of other industry players, so that you understand our perspective in detail, then do whatever you feel is correct for the country. Definitely you will not look at what. Absolutely. But it is very important. And when Prasanna said that they come to us, they go here, there, and they take a call, okay, this is a better model. But rather than it could be more collaborative. So what I feel is being an NBFC sector guy for 15 years, this has tremendous potential. But possibly all three parties are stretching it towards their own purposes. We will not reach to the conclusion of 1 trillion, 2 trillion, or whatever is the potential. But is there any way of bringing everybody to the common platform, not towards the purpose, but by deciding, okay, chalo ye karte hai, and possibly this can take it to there. And RBI has the largest role to play, because whatever we decide towards the technology, etc., they will throw one bouncer, and that we have been seeing in all DA securitization guidelines throughout our lives, that every 2 or 3 years they will set a bouncer, or next time bouncer के लिए ready है, they will throw a yorker. तो हम बोल्ड हो जाते हैं. तो possibly how we can do that as a common practice, and possibly that can push us towards that 1 trillion or 2 trillion.
I think it's a very, very, very valid point. I've never seen multiple financial institutions definitely work together to create a forum which can address big issues, because there are always interests of individual institutions. Swift is a perfect example. They've been trying to modernize that element for ages, but it never gets done. However, having said that, I think what you articulated is a very valid point, and this is our humble attempt to get that done in this way. There was an opportunity. I mean, it's easy for a tech company to develop a product in isolation, which is what we all do, and then say, here's a great product, please plug and play. That is one way of doing it. We've done that, and it's not that New Street doesn't do that kind of stuff. We've done that. We've gone with one product, sold it very well. It's giving us our bread and butter, etc., etc. But in this case, co-lending by definition means collaboration, cannot be done without that. And we realized that when the opportunity came for the third cohort of the RBI sandbox, we grabbed it and we put co-lending and MSME into the equation. It was an MSME cohort, and we said, MSME platform that we can create at any point of time and sell to individual organizations. But if we can use this auspices to do the collaborative effort under the RBI's purview. Now, we also know that there has been 2 cohorts before. Nothing, I don't think anything has come out which has grabbed headlines until now. We know, it's been a modest this thing. But what we want to do this time around is, as we come out, and the testing phase has already started. We just finished our first testing yesterday. The test results we sent to the RBI for them to have a look. What we want to do, as you rightly pointed out, is to make them a party to this in some form. And this is an open question. Would NBFCs and banks, and I've got a very different answer in a different forum, are they okay to let the RBI have a direct view into transactions as they happen? Because this is decentralized ledger. Remember that the RBI can, if we put them, if the node, it's all it takes is a simple node to be present, made available to the RBI. Audit will happen on its own. It can even go to a stop press action button, which means that if there is an incorrect transaction, you don't need to wait for 2 years later to find out that the RBI you violated some guideline, and it comes back to bite you 2 years later with a large fine. It will automatically trigger an alert. Like in the case of cross-border remittances, a suspicious activity report is generated. It will automatically create an alert, tell both the NBFC and the bank that, hey, stop, don't do this because of ABC. It will also create a record for the RBI to have a look and see the corrective action. There's huge pluses to doing this, because you would have self-corrected it yourself, which will take away the RBI's punitive action. So that level of testing we can do today. So if banks and NBFCs agree, we would like to go down that path and say, we can, when we come out of this cohort 3 months down the road, we will actually create a system which will engage the regulator into the whole equation. Is the industry ready for it? That's not. We don't need to answer that question, but that's a thing that we would.
The objective of bringing in blockchain as a technology and testing it out is there, that you focus on the business aspects. How it's getting done between multiple organizations can be beautifully addressed by technology and a platform.
And if this is achieved, maybe by 2025, this could be the new thing by India to the world.
Yes.
Co-lending is not an India issue at all. I mean, it's a global issue.
Absolutely. So new thing that banks and all the participative people are coming on the same platform as a blockchain. Because so far at a global level, blockchain is only related to crypto in a majority cases. But this is big. This could be largest use case.
RBI is currently very reluctant to approve crypto transactions. They consider blockchain is like crypto only.
I think interestingly that is changing. Yes, 5 years back it was. I remember going to one of the forums and the question asked was, what do you think about blockchain? And none other than a very, 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 very high up level in the RBI said,
since so many experts are here.
Endorse crypto, nor do we are we against crypto.
Thank you very much, Banking Frontiers. On behalf of Banking Frontiers, I appreciate all of you for joining us, for being part of this wonderful discussion, and we'll look forward to inviting all of you again for similar such future discussions. Thank you once again. Have a great day.
Thank you.
Thank you.